So, how do you get that explosive growth you see in a top tech stock, but also get a steady, reliable monthly check in the mail? It's the classic investor problem, right? Well, today, we're going to break down an ETF that claims it can do both.
You know the feeling. It's this constant push and pull. On one side, you've got the absolute thrill of growth stocks. I mean, these are the companies literally shaping our future. But on the other side, there's the very real need for consistent income. And for most of us, it has always felt like you have to make a choice. You got to pick a lane and just stick with it.
And let's be real, who doesn't want to own a piece of these titans? We're talking Nvidia, Apple, Microsoft. These are the engines of innovation. This is that growth side of the equation, the part that gets everybody excited about those big potential returns. The problem, of course, is they don't typically write you the big monthly checks that a lot of investors really need.
But what if that choice was a false one? What if you could actually aim for both at the exact same time? Well, that is the entire premise behind the Amplify CWP Growth and Income ETF, ticker symbol QDVO. It's an actively managed fund that's designed to tackle this very problem head-on.
All right, so here's our game plan for today. We're going to look at QDVO's two-part strategy, uncover what makes its approach tactical, we'll peek under the hood to see what it actually owns, and then of course we'll cover the essential risks so you get the full picture.
So, the big question is, how on earth does one fund try to deliver on two goals that usually seem to be in conflict? The answer, it turns out, is a pretty fascinating hybrid structure.
You know, the easiest way to think about QDVO is like a hybrid car. It's got a growth engine, which is that portfolio of big-name stocks we were just looking at. That part is all about capital appreciation. But it also has this income turbine, an option strategy that's running right alongside it, and that's designed to generate a steady stream of cash flow. Now, this isn't just about randomly buying some growth stocks. It's a really deliberate multi-step process. First, they start wide with large-cap growth companies. Then, they make these big-picture calls on which sectors to favor or avoid. From there, they really narrow it down to a concentrated portfolio of their top 20 to 40 best ideas. But it's that final step, tactically selling options. That's the key to how they generate the income.
And for anyone who's not familiar, let's just quickly break that down. A covered call is when you own a stock. Let's say you own 100 shares of Apple, and you sell someone else the right to buy those shares from you at a specific price by a certain date. Just for selling them that right, you get paid a fee, which is called a premium. That premium, that's your income.
Okay, so a lot of funds use covered calls. That's not new. But QVDO's whole argument, its secret sauce really, is how it uses them. And that brings us to the tactical difference. Okay, this is the core concept right here. Most income ETFs you see are systematic. They just mechanically, automatically sell covered calls on everything they own all the time. The massive drawback to that is it caps your upside. If a stock you own absolutely soars, well, your gains are limited. QDVO's approach is tactical. The managers are actively deciding when to sell a call to get some income, and maybe more importantly, when to just step back and let a winning stock really run. And hey, don't just take my word for it. The fund's own documents confirm this is a strategy. They are designed to be tactical, specifically to avoid, and I quote, limiting potential upside. So really, the bet you're making here is that an expert manager can make smarter decisions than a simple, automated computer program.
Okay, so that's the theory, but what does this all look like in practice? Let's pop the hood and see what's actually inside.
Right off the bat, you can see this is a very tech-heavy fund. Information technology makes up almost half of the entire portfolio. And if you add in communication services and consumer discretionary, you're looking at over 3/4 of the fund being in these really growth-focused sectors. So let's be clear, this is not your grandfather's old utility fund. Its DNA is definitely in growth. So how's it all worked out so far? Well, since it started, the fund's return has kept pace almost exactly with its pure growth benchmark. Now look, this is a very short time frame, and we all know past performance is never a guarantee of anything. But it is pretty interesting that it managed to do this while also delivering that stream of monthly income. And that brings us to the bottom line. I mean, this all sounds pretty compelling, but no investment strategy comes without risk. It is absolutely essential to understand what the trade-offs are.
Yeah, every strategy has its trade-offs. The big one here is that even with a tactical approach, the fund could still miss out on a massive, unexpected rally in a stock. You've also got the natural volatility that comes with growth stocks, plus the fact that this is a pretty concentrated fund. So if a top holding like Nvidia has a bad day, you're going to feel it. And finally, you are betting on the managers. If they make the wrong calls, well, the whole strategy might not work as intended.
And that really brings us to the final question. QDVO makes this compelling case that a human, tactical approach is the key to balancing growth and income. It's a big bet on active management in a world that's pretty obsessed with passive funds. So the question for your portfolio is that a bet worth taking?